Welcome to the webinar on governance, key success factor for entrepreneurs. My name is Jean-Christophe Barth. I'm the co-founder and member of the Supervisory Board of the European Champions Alliance. The European Champions Alliance is a non-profit association created in February 2020 that built an ecosystem of startups, scale-ups, SMEs, corporates, and industry experts committed to European tech and values. The Alliance leverages its European network by sharing market knowledge and activating joint business opportunities between the members to support the growth of European champions. We do this in several focus groups, for example, cybersecurity, smart industry, mobility, innovation, and now also space tech. The sequence of events are such that we will first hear a short keynote from Charlotte Valeur, member of the board of the directors of ecoDA, which is the European umbrella organization of the national good governance associations. And we will then start with short abstracts from our esteemed panelists. Our speakers will present themselves as well as their governance experience and make a short presentation of 5 minutes before we discuss the key challenges with all participants today. Please make use of the chat box. We'll take on the questions and we'll answer them to our best capacity. It's a great honor for me to moderate this very first webinar on early stage governance organized by the European Champions Alliance, and we hope that this is the beginning of a series of further contributions on this important topic. The work we're presenting today is based on our guide on early stage governance that will soon be made public. This guide covers the governance from the inception to the A series, and it's a stepping stone towards a pan-European approach. We have the pleasure to welcome a keynote speaker, a corporate governance expert, Charlotte Valeur. Charlotte Valeur has over 30 years of experience in finance, primarily as an investment banker in Denmark and in the UK. She has an extensive portfolio career with a number of non-executive directorships and chair roles, as well as delivering training globally in governance, best practice, and advising boards on corporate governance through her company, Global Governance Group. She's the immediate past chair of the Institute of Directors in London and as a member of the ecoDA board in Brussels. I wish us a lively and enriching debate on this highly topical issue. And without further ado, I would like to give the floor to Charlotte Valeur.
Thank you very much for the very nice introduction, and I'm delighted to be here today. Thank you. I wanted to just start talking a little bit about purpose and impact. And entrepreneurs are the backbone of every country and the ones that are really coming forth with new businesses and new ideas that build countries and solid organizations in those countries. To make them more solid with my obvious passion for corporate governance, I will sort of have a little case for why it's important for entrepreneurs to ensure that they take that into account. With corporate governance these days comes purpose and what your impact is. And the impact is both socially, environmentally, and financially as well. All of those factors should really be part of the purpose that you decide for your organization of why are you even here. I think implementing a governance framework that includes both the social and the environmental impact that your organization have these days has become absolute key. And it's something that we're discussing no end in governance circles to see how can we create a governance framework that can take those values into account at the same level as the financial values. I think having governance generally comes over and above the impact you have, and it's what you use, the framework you use to make sure that it happens and to give some oversight and also to give new ideas to why it happens. Having a board that can set out a good governance framework for your organization early on is giving you help and support to grow in the right kind of way that will make it easier for you to attract external investments. We do a lot of work with London Stock Exchange, for example, as well, around how to prepare for an IPO, which is obviously for many the ultimate level of external investment that you would like to have. And I think ensuring the governance framework is in place with a good board that supports the entrepreneur who would more often than not also be the CEO is an absolute key to get things fully right. It's very hard for one person to see everything. And when you bring other people into the decision-making process in a structured way, you ensure that you see with many more eyes whenever you make decisions. Making the wrong decision can be incredibly costly. And sometimes the wrong decisions can be simply that you don't see all the risks and opportunities because you have only got your own set of eyes to see with. So ensuring that you bring in a good board with people that are supporting and helping and also challenging, because it's through people disagreeing with us that we truly grow. So we should always welcome those kind of disagreements. I had this kind of conversation with my son this morning, who's studying business, and he said, well, if he had his own company, he wouldn't want to have a board. He would want to make all his own decisions. And I was trying to explain to him why a board can add value rather than detract control. But his focus was very much on keeping the control of all his own decisions. I can understand that. But when you grow a little bit more, you understand that having other people help you make the right decisions in a good framework will be overall better value for yourself and your organization. And I think that's enough for me for today.
Thank you so much, Charlotte, for your keynote. It's really inspiring to have somebody with such long-standing experience share his insights with us and all the people facing now early stage governance questions. We'll now hear our first substantive expert speak, and let Charlotte Valeur join her board meeting, which she interrupted just to do the keynote. If we're lucky, we'll be able to have her again with the question and answer part. And I'll now introduce Alan Tawil-Kummerman, who is independent director and who started his professional life as a banker with Lazard in London, and then joined his family business, MacGregor, a major player in the shipping equipment worldwide, which was sold to Krone, a Finnish industrial group. He then invested in several startups, co-founded one, which was an online digital photo company that was sold to Hewlett-Packard. He's today an operating partner at a Luxembourg-based private equity firm, and he serves as a chairman at 2 different companies, one in the HR field and the other in a fast-growing US-based logistics company. Alan became a Sloan Fellow after earning a master's degree in management from Sloan School at MIT. We'll hear Alan share his insights on first forms of governance and a deep dive with an example on a memorandum of understanding and process, as well as how articles of association should be shaped. Alan, the floor is yours.
Thank you very much, Christophe. Jean-Christophe. Wow, what an introduction. I'm impressed. Anyway, this section of the conference is really for you guys that are starting up. And we're going to talk about 2 things, the MoUP, Memorandum of Understanding and Processes, and the Articles of Association very briefly. Let me tell you a story, in fact, that happened. Jean-Christophe talked about a company that we sold to HP. Well, so it sounds like a success. It was a success, but it had its problems. And one of the problems is that we were 3 founders, and one of the founders eventually got kicked out and was not on the finishing line when we sold to HP. And the problem was essentially that this guy had ideas about how to benefit from his job in the corporation that wasn't in line with the 2 other co-founders. He wanted to get a fat salary, live a high standard of living on the company's expenses. And we didn't realize that since the beginning, where the other 2 founders, we were really more into building a significant player in the online photo market and delivering a good product, which we did. So, but at one point it became untenable, and the board had to fire him. By that time, we had a venture capital investor inside the company who didn't like the fact that the guy had left for the US to develop the US market, spending a lot of money and not being accountable to the board. And Charlotte was saying, you know, you want a board to so that you can take your own decision as a founder as well. I just support what she said. I mean, it's good to have checks and balances because very often these people can save your lives, literally. Why do I tell this story? Well, if we had done an MoUP, maybe we would have avoided the problem, because the MoUP is essentially the area where you're going to agree on your objectives, on what you're expecting from the company, on what you want to give it, on how you're going to operate, your modus operandi with your colleagues, the company culture, and essentially form a well-united group that would be useful, because then when you get into operating the company, you will be on the same wavelength, or you will have work to be on the same wavelength. And it also, in some ways, a process, because if you do disagree, then you have to make sure that you, at the end of the day, agree, especially if you've got a professional investor coming in eventually. And I don't mean this in an adversarial way, I just mean this in a coherent way. It's really very important. So on the screen, you have 10 particular points. Remember that the MoUP is not a statutory document. This is not a document that you want the lawyers to work on. This is a document for you as co-founders, shareholders, initial shareholders, to really think about these the different subjects that are here on the screen, and reflect on them, and discuss them, and decide on them. But this document can be anything that you want it to be, to ensure that your future and the development of your company will be smooth. I'm today on 2 startups in the US where I'm chairman of the board. I've put in place these MoUPs. One is now 2 years old, and the organization is fantastic because it does discuss all its problems, and we're all on the same wavelength, and it's a real joy. So that's for the MoUP. I'm happy to answer any questions now, today, tomorrow, next month, next year. If you want to email me, get in touch, no problem. I'm happy to help. We can talk briefly about the Articles of Association. That's a less interesting subject in my view. They're pretty much a standard document that in any legislation, this is the place where you actually put the purpose of the company in. You talk about the different shares, the category of shares that you may want to have if you want that. This is how the General Assembly is organized, how the Board of Directors is organized. You nominate your auditors, you define your financial year. You talk about the liquidation process if it comes to that, hopefully not. And also, in final, the communications means that you will use to communicate with your stakeholders. It looks like a detail, but it's not. It's actually quite important. So that's really the key points, and on to the next speaker. Thank you, Jean-Christophe.
Thank you for sharing your insights on how to make this MoUP fly in a startup context. Next up is Jean-Louis Flamand, who served as a Chief Financial Officer and as Chief Executive Officer for manufacturing groups, mostly US-owned companies in the food and fast-moving consumer goods sector. He co-founded FinUp.net, an investment holding company specialized in the pre-seed financing. Furthermore, he's a business angel and a board member in several startups and investment structures. Without further ado, the floor is yours, Jean-Louis, who will speak about what must happen before going to external financing. And the floor is yours, Jean-Louis.
Yeah, can you see me?
Yes, and hear you.
Good evening. I will develop 2 points. What is the first round, and when be ready to raise money? What is the first round? It comes after family and friends. This is the definition in Europe. In the US, it's usually Series A round. Investors are angels like me, experienced big companies, CFOs, CEOs, marketers, R&D. They know your markets. They offer a smart money, which means money plus time, plus business contacts, and often a seat in your board. They are certainly not bankers. So we are good investors. But at this point, two warnings with them. First, you will not fool them. And second, should you fail when pitching, there is no second chance. So this is for my point one. Point two, when be ready to raise money. You will be ready when you have two types of bodies. First, have a complete operational team. Full-time people, balance expertise, sales, finance, and development. They form what we call the management team in charge of the day-to-day operations. So this is body number one. Body number two, along, you will have a board. Whatever you call it, strategic committee or advisor. This board is in charge of strategy, business plans, new people, and you meet with them every 2 months. So management team plus the board is what is our definition of governance. So best founders have a governance, they have a strategy to raise money in that order. That's it.
Thank you very much, Jean-Louis, for these insights into the first round of finance. Next up is Olivier Gras, who, after high responsibilities within the Direction Générale de l'Armement of the French Ministry of Armed Forces, acquired a deep knowledge in the French and European defense technological and industrial base. He also supports startups. He's a teacher at Sciences Po Paris School of International Affairs, and I'm always impressed by the number of innovations and the ability of this defense sector to team up and partner up with startups. And we're very happy to hear Olivier now speak about the first shareholders agreement. Olivier, the floor is yours.
Thank you, Jean-Christophe, for very kind words, so impressive. So it's my pleasure to share with you this afternoon some simple consideration about this essential mark point of an early stage company, that is the first shareholders agreement. Startuppers, you have a dream. Investor, you have money. How to make investor trust your dream? There is a tool for that, the strategy. Startuppers, you have demonstrated the validity of your strategy. The goal, that is the market you are aiming at, is realistic. Your products are being bought. You are on the path along you have drawn to reach your goal. You have the appropriate skills. You form a solid and reliable team. You are along this path just at the first milestone where you need money to continue your development. As your strategy is sound, the investor will begin to trust you, and this is a good position to enter a negotiation. To have a sound strategy, you will need support from somebody else who helps you to look beyond the day-to-day business, gives you external looks and advices of your business. That is the government's body you have put on work. Whatever its form, the importance is its finality. I recall that among the tasks of the government's body, strategy is the main one. I am not exhaustive. Your governance body will be very helpful to prepare and support the startup in negotiation with the investor. At first, what the party wants. It is essential to identify the intention of the parties. What is their goal? What is their agenda? Within this fundamental point, the duration may be different. What exit expects the investor and when? In which conditions? What after? You have to be consistent with the rights and obligations of the founders as written in the MoUP, as described Alan. What will be the life? What form of governance, if not yet formalized? What share of capital represents the investment? This is a difficult negotiation as it reflects the value expected of the company. Who takes the decision and at which majority? For example, appoint a new executive, launch a key development. What about the key persons identified by an investor? Are they free to leave the company without questioning the investment? Entrance and exit for shareholders. I am not exhaustive. Just to point that before entering the negotiation, you have to identify the key issues with the governance body and identify the red lines. Keep the possibility to say no if you consider that your red lines are crossed. Next, please. Having in mind the key points, you negotiate. The wording is a shared wording between the start-upper and the investor. This is not an all-prepared document asking only for a bottom and for a signature at the bottom. All clauses have to be negotiated in a good and mutual trust. And you recall that you are at the first milestone on your path. As you will go on your path towards the following milestone, where you need extra money. Keep the door open for next step of finance. In this negotiation where legal words are at stake, it is essential that the startup be also supported by a legal advisor. It must be independent, free of conflict of interest. It is in this in-depth negotiation addressing frankly all the key points that the mutual trust between the startup and the investor will be reinforced. The first shareholder agreement will enlarge the first agreement between the founders and will allow the young company to go along its path to make its dream alive. Thank you for your attention.
Thank you very much, Olivier, for sharing your insights on how the first shareholders agreement should be structured. Now we'll hear from Gérald Farrenc, who's also an independent director. Gérald spent his career in the electronics and telecom sectors in Thales, Alcatel, and Alcatel-Lucent groups, and in the aeronautics at the Safran group through diverse executive positions. He's been an expatriate for more than 12 years in different countries, and he's active as a business angel and supports various startups. He's the chairman and CEO of an investment fund, and he's a member of Invest Essor, the first business angel network in France, and president of the Alumni Business Angel Group. He's a lecturer and coach at the ECA Business School, and also serves as non-executive director and leads a consulting firm in strategy and international development, as well as commercial organizations. Gérald holds a master's degree from École Centrale Paris, graduated from CESA, Finance HEC, and is certified company non-executive director IFA Sciences Po Paris. We'll hear Gérald speak about the venture financing and professional investors. Gérald, it's your turn.
Thank you, Jean-Christophe. Thank you a lot for this wonderful introduction. Yes, let's talk a little bit about the venture financing and professional investors as a whole. Once the startup has demonstrated its viability, as we have mentioned before, the entrepreneur team looking for further growth may have to find fresh capital through venture capital investors, corporate venture funds, family offices, or the like. It should be done with sufficient anticipation to avoid negotiation in a hurry. First, the venture capital investors, they are firms aiming to invest in non-listed companies, mainly startups. They are governed by strong expectations on the return on investment on invested funds, with a typical maturity over 5 to 7 years. Corporate venture funds on their side, owned by industrial groups, are investing directly or indirectly in capital of SMEs as part of a global strategic approach to innovation and development of the group in subjects related to their activities. As such, the corporate venture funds pursue objectives which are significantly different from the ones of a venture capital investor, in particular in terms of exit deadlines. Now, what about the new shareholders agreement once we have professional investors on board? When a professional investor is considering investing in a company, he typically proposes a term sheet which lists all the conditions under which they would invest. The existing governance body, before the entry of the professional investors, should carefully review and negotiate all important items with a new investor, the new potential investor at that time, before finalization of the term sheet, having in mind previous agreements and the Memorandum of Understanding process, the MoUP. To do so, governance body must assist the entrepreneurial team to answer the following. What are the investors' values and culture? What is their investment horizon? Do they pursue a dormant or a proactive role? What is the capital table post-investment? New governance body, the relationship mode? And also, do they bring value apart from financing? Several conditions could be requested by the new investor, such as mentioned, a new governance structure, but also preferential shares for them with typically preferential treatment at exit. This should be carefully reviewed by the existing governance body together with the entrepreneurial team. The pre-money evaluation is the result of it's a balance, the result of the appetite of the new investor and the ability of the entrepreneurial team to convince they will succeed. It should also allow for further fundraising without excessive dilution, depending on the business model for sure. But this should be taken into account in the negotiation. The investors' exit conditions are one of the key points to negotiate for both parties to understand and accept each other's needs. As well are the investors' needs for information to allow the investor, to allow them to comply with their own responsibilities. The new shareholders agreement would better take precedence over the articles of association. Its clauses, like with business angels, mainly relate to first, typically a recital on intentions of the parties, then capital control clauses, then governance, investor exit, as already mentioned, obligations of the founders, and other general clauses. And in any way, it's highly recommended that the entrepreneurial team get advice from an experimented lawyer in the matter, as well as it was before with business angels. Thank you very much. Now I pass the ground to Jean-Luc for the Life with Professional Investors.
Exactly. So Jean-Luc is a former French Navy officer and risk manager in investment banking. He founded an IT company in 2000 and merged it in 2011 with another IT company named Talent. In 2020, the company had 3,000 people and a turnover of 300 million euro. Since 2019, he's been a private investor and a member of several boards and startups and private-owned companies. He holds a master's degree in the French Naval Academy and an MBA from HEC, I imagine Paris, because there's so many HECs. He is a certified company non-executive director from IFA Sciences Po Paris, and also a member of APIA, des administrateurs professionnels et indépendants associés. And as such, he will speak to us now on the governance with the fund and the exit of the funds. Jean-Luc, your turn.
Thank you, Jean-Christophe, for this kind introduction. So now that the startup has a new investor in its capital, there will be a new governance and a new board, obviously. And the first and the most important issue to address now is the balance of the power in the new board. The founders should not hesitate to call on the expertise of the fund. More and more VCs use specialists of various fields to help startups. On their side, the fund representatives must be careful not to restrain the managers with a single idea to protect their investment. They should never forget that startup founders are not usual managers. Regarding the members of the boards, the founders should obviously not nominate close friends because they are friends or family. It seems obvious, but I saw the situation even in startups. Also, in order to maintain a real separation in the governance between the board and the executive committee, our advice is that the founders should be careful before nominating the board over managers than themselves. For their part, ideally, the funds will nominate people who are not only finance people, but also who have a real ability to understand the startup business. And this is not easy, also people with high interpersonal skills. We definitely think that at this step, an independent member will have a great added value to the board. He can help the founders in strategy, technology, or specific business matters, but also he will help the balance of power and the alignment of the different points of view in the board. So now we have a board. The board is set up. His members will have to ensure a permanent strategic alignment. This means that the strategic objectives must be regularly reminded during the boards or collectively modified if necessary. And this is all the more important that the situation of the startup or of its environment are quickly changing. Well, the year 2020 is a very good example of very fast evolutions. One final point I wanted to emphasize is regarding the governance with the corporate funds. We have to keep in mind that some corporate funds may limit the presence of their own competitors as customers. They also may try to dispatch their investments in various startups in competitions with each other. At the end of the life, with an investor, there is an exit. The various situations will then be an entrance in the capital of a corporate, directly a corporate, or a corporate fund, or a new fund. And for some happy few startups, well, actually more scale-ups, the exit of the fund may result in an IPO, like Airbnb nowadays. Well, obviously, these various situations may all be different if the founders keep the majority of the capital or not. When we reach this step, the central point for the founders is their motivations. It's a new world for them. They must be sure of what they want to do. They must also be conscious that if there are several founders, they must also be conscious that their individual motivations may be different. They should be clear about that and talk together. Regarding the future, the next step, they should analyze the objective of the new investors and negotiate their involvement in the new structure. The startup has grown, and the expectations of the new investors regarding governance will be higher, definitely. And an exit is not an end, it's the beginning of a new adventure, a new phase. Thank you, Jean-Christophe. Thank you all.
We now will open up the floor for any questions that you may have. Since I don't have much in the chat right now, we'll simply start off with a question that I would like to ask the panelists. Should family and friends be members of the first board? And please open your microphone if you want to say something on that subject.
I'll be happy to give you my answer on that one. I think that it is okay for friends and family to be on the board, provided they have an understanding of what the entrepreneurs are trying to do and they have some kind of experience. It's useless to have somebody sitting in a meeting saying nothing or saying irrelevant things.
Anyone else who would like to take the floor? Jean-Louis? Pinal, you seem to want to speak. Go ahead.
You're on mute, whoever's wanting to speak.
I know Pinal can speak.
Thank you, Jean-Christophe.
Okay.
I would add that good investors are ready to stay in board many years because they don't know when the startup will exit. So when they invest, this is not like a fund with a limited horizon, you know. Also, the first investors who are members of the board are often treated as rich co-founders, and certainly not like a bank.
Thank you. Anyone who listens in who also has an opinion he would like to share on that topic?
Well, yes, it's Jean-Luc. To add what said Alan, I think that the phase where you have only business angels is not the same step when you have professional investors. So close friends and families, I think, are more welcome when you have only business angels in the capital. When you have professional investors, you must be very careful as a founder to incorporate close friend and family.
Thank you. Then we have an interesting question coming here from the audience. Typically, how are board members remunerated? Who would like to answer?
Usually they are not. They are not. When the board is formed, called a strategic committee, the first board members are investors, and they don't mind of being remunerated.
Because they see something that is doing like this at the end of the tunnel.
Exactly.
Okay.
Yeah, Jean-Christophe, maybe I can add something. Whenever you get on board an independent director, I think it's as that's typically being independent is not having any investment in the company. Now, in that case, you should plan for having some compensation for the work done and the competences brought to the company.
Is there a thumb formula on how that remuneration is calculated so that the startups have an idea how to calculate that?
Not a formula. I think it's typically related to the extent of the work to be done. Number of days, for instance, that is typically expected from the independent director or counsel, and also in a number of cases the startups are not having too much of cash, and depending on the rule in the specific country, other ways of remuneration can be implemented. For instance, some shares to be given at a later stage or something like that, depending on the case and the country you were.
Thank you. Then another question here asking, should the board members represent different competences and or come from different countries? So the aspect of diversity in terms of multi-competence and diversity probably also in terms of gender balance, and you know, if you work with certain markets, it's good to have somebody who knows well the market. What's your opinion on that?
Yes, I can say that it is very essential that diversity in the board as one of the aspects of the board is look at global look, 360 degrees, so avoid any hole. So it is very, very important to have diversity and the appropriate skills related to the essential issues that the startup is aiming at. That's important.
We have in the chat a question saying, it was mentioned that board members should have great interpersonal skills. How does that matter? And what would be the pitfalls of such soft skills missing in the board team?
Well, I will start to answer this very complex question, and very interesting question, if you like, Jean-Christophe. There is a big difference between startup and large companies. In large companies, the real power is in the executive committee, since most of the time the capital is spread in with various and many different investors. In startups, generally speaking, the founders do have the capital power at the beginning. So if you are a new board member, a very strong executive guy who is coming in the board and trying to interact like he's interacting with his people, he will face a very strong opposition from the founders. So one of the most interpersonal skills, most important interpersonal skills, is that the humility, if we say this in English, the humility that everyone should have. And I think this answers also the second part of the question. If you don't have this, you could have many blockades in the board.
Thank you, Jean-Luc. We have another interesting question from Pinal Patel. Well, how do you determine valuation in a state of constant fluidity in the marketplace? What valuation model of investment is sustainable through this pandemic environment? And kindly share your insights you may have.
Well, I can try to start to answer that one. The valuation, as I said, is the result of a balance between the willingness of the investors to invest in the company and the way the entrepreneurial team can convince that they will succeed. Then, for sure, the valuation of the startup it can vary quite a lot depending on the environment, and not only the global environment, but also the financial environment. And we can see that this year, where we have found in a number of cases traditional startups, traditional sectors of startups with valuation decreasing a lot due to the lack of visibility for the future in sectors like tourism or the like, or transport. And in other sectors, we are seeing emergence of a lot of startups in the medtech, where the valuation, the most difficult part of the valuation is to be able to determine the risk of non-succeeding, in fact. And then I think it's you need in some cases a very good advice technically on things that you don't understand, and on the other side, being able to a little bit evaluate what are the chances of success of that project. But in startups, and I think it's valid for business angel as well as for professional investors, I think that the greatest part of the evaluation is what do you think about the team itself, the entrepreneurial team itself? In fact, for business angel at the beginning, 2/3 of the decision is the team for me, and 1/3 is the project. It's probably more balanced when the professional investor invests, but the team is really still very essential.
So in other words, with a good team, you can rock the boat, and if you don't have a good team, the best boat won't be able to rock anything.
Yes.
Okay.
Absolutely.
Agreed.
So any thoughts on pooling investors for board seats?
Can we just give another view of this valuation thing?
Yes.
First of all, I mean, I had at school a fabulous accounting teacher, and whenever he was talking about figures with somebody, the first questions is to ask the guy who's asking, who are you and why do you want to know? And the reason he's asking those questions is that, of course, when you have the answers to those questions, your valuation may be completely different from one guy to another. So I don't know what the person who's asking the question has in mind, but you can value your company at times where you have people that need to know because they need to have a valuation on their of their shares for fiscal purposes. Obviously, then you have the valuation for potential buyers. But when you have potential buyers, you have to consider the nature of the buyer. He could be, and in fact, you may be doing a whole lot better with a corporate buyer who has an interest in buying your company because it's complementary or to his activities, and it'll give him great synergies, and the price may be high. As opposed to an investment fund who is going to resort to the valuation methods that you can buy with any competent firm. So I just wanted to highlight that view of things because it makes a difference.
Maybe Pinal would like to give more context, and tell us if our response is satisfying his question. Pinal.
It seems he's not in front of his camera.
Okay, no problem. So, I mean, everybody who's in the room now, please feel free to open up your camera, and if you have a question, you can voice it. No problem. It's here for you. I think that's the added value of having so many experts here to seek guidance. The question from Stefan Trockel was, any thoughts on pooling investors for board seats?
I don't understand the question.
Stefan, can you maybe explain?
Sure, thank you. I think it's especially in early phases when you have angel invests with rather small equity amounts. Some of them would, just in terms of my understanding of making things manageable, would be interesting to pooling them in terms of votes and in terms of presence on the board. So I don't want like several angel investors just basically having no voting power because it's too little equity at some point, or I mean it just distorts the whole thing. So and I think at an angel level it appears to be an act of governance, so to speak, to pool some of those angel investors together in terms of voting on the board.
Yeah.
I think it's systematically the case with business angels. Typically, you get a batch of business angels, 15, 20, up to 30 business angels on board in order to have the global value of what you need to rise. And what is systematically done is that you define whatsoever a board or governance body or advisory committee where you get one or two maximum representatives of these 20 plus business angels. Normally, you should agree between the business angels and yourself who are the best to bring added value to the case and to the project, and typically make the link between the whole batch of business angels and the managers and the entrepreneurial team. The one or two business angels on board with the entrepreneurial team are working together. And whenever needed, what the added value of having 20 or 30 business angels is that you get them waiting for a requirement for any introduction, opening up their network. Then you get 20, 30 networks of people. But there are only a couple of ones acting on a daily basis with the team.
I could answer Stéphane with my own experience. Usually, when a business network enter to the capital of a startup, say a stake of 20% for 600, usually they need 4 business angel networks, so each approximately 5%. All the network do not want necessarily to be part of the board. Usually 1 or 2 want to be active part of the board. So this is eventually what happens when sharing the participation to the board. Usually 1 or 2 business angel network wants to be part of the board, representing approximately 5% of the capital, first time.
One other comment on this is more an administrative chore. At times during the life of the company, you're going to have general assemblies with approvals from shareholders, and sometimes it's a unanimous requirement. And that's where it gets an absolute nightmare if you don't have somebody representing and having a power of attorney for all the other shareholders. So make sure that that's provided for whenever you start. And that's different from participating from the board. The other thing, of course, with all these smaller shareholders, my view, it's important to keep them informed on a regular basis, because if they are not informed, that's when they become trouble.
Thank you all very much.
Good. Happy we went after that question, so now we have really clarity on that. Andrea Christina Vaughan asks, how do you go about finding good and engaged board members if it's not possible to recruit them in your own network?
Well, I will start to answer to this question. I have an example nowadays. I'm a board member of a startup as an investor, and we are looking for an independent board member. So each person of the board has tried to find a good person in his network, but also what I realized is that the headhunters are very interested now to find board members for companies, because they think and they realized that some startup will become very large companies, and to be at the very beginning, to help the company at the very beginning, help them to be to gain more clients. So my advice will be to address to a headhunter company for this, and they will not ask for fees, for large fees for this. They have a very long-term interest.
We may add that there are some organizations who are proposing that kind of people. In France, you get the APIA, which has been already mentioned, where we are a number of available independent directors. You get also in France the IFA, Institut Français d'Administrateurs, and in other countries probably the same. I don't know, Jean-Christophe, in Switzerland, if you get some.
Yes, there are also networks like this. I mean, there's APIA Swiss, there is VL Swiss, and other networks that, let me just share a couple of links here, where you can have a search being done to find the right profile. Sometimes companies would like to have somebody with, in Germany, we say Stallgeruch, so the odor from the stable, from your industry. But it sometimes is an advantage also to take somebody who's from a completely different field and who brings new skills to the board, especially if you're looking at expanding and you're in a hyper-growth mode, which is precisely the type of startups and scale-ups that the European Champions Alliance is accompanying and trying to help. Yeah. Next question is, how do you best assess cultural fit between the business owner and incoming investors or non-executive directors?
That's to me a very important question and also a complicated matter, but it's a matter of judgment. I think it's if you want to assess this, then spend time with the person. Make sure that this person also spend time with the other board members, and then check if he's a fit. You'll find out if you talk.
And I see that Charlotte is back with us, so we'll have an additional expert who can also help respond to any queries from the participants. I had another question here about should the governance body be included in the company statutes or only in the shareholders agreement? Is there a special regime for example, the SAS? Is the question clear, or should I repeat?
Yeah, better repeat, maybe.
So should the governance body be included in the company statutes and the articles of association, or only in the shareholders agreement?
Well, what I would recommend is that the details of the responsibilities of the governance body and the way the people are nominated to it are probably better to be detailed under the shareholders agreement. However, what can be mentioned in the articles of association is the existence of such a body without full description of their prerogatives and what they have to do. That would be my advice.
Super.
Yeah, I agree with this. I just would like to state an experience that we're running today. When in fact, in this latest startup that I'm participating in, we actually defined in the MoUP, in the MoUP already something about that. And essentially today, we have a structure where we have a board of directors and a general assembly, and that's in any case in the articles of association. But also the boards have committees, and there are mainly two committees. One is the remuneration committee, and the other one is the audit committee. The remuneration committee is obvious. That's discussing salaries, structure of the company, bonus structures, share option schemes, and so on. And there's generally a committee. In some countries, the committee has to report to the board and the board decides. In some other countries, actually, the remuneration committee takes the decision and that stands besides the board. So we are with a governance system where we have what we call the MoUP group, which are essentially a bunch of co-founders. There are about 10 of them, if I remember right. And that is essentially the remuneration committee. And it works in tandem with the board. And that, it works pretty well. I'm quite surprised, but it works pretty well. So you can, I think the message is that, again, you have to do your governance tailor-made to your business, to your organization, to your people, to your company culture. That really is the message, and you can be creative, and then you can check if your creativity is totally legal or not by going to a lawyer that is competent in the matter. But it's formal stuff, but you can really be open-minded about those things.
Christophe, maybe what we can add, I don't know if everyone knows about the difference between the Articles of Association and the Shareholders Agreement, but typically the Articles of Association are made public and accessible to any third party. And then as such, it can be whatsoever is in the Articles of Association can be opposed to any third party if there is a breach of the articles. Yeah. However, the shareholders agreement typically are private agreement between all or part of the shareholders of the company, and as such, they can write whatever they plan to do together and the way they rights and obligations within that frame, and it's not public.
Exactly. So in legalistic terms, there's two notions. One is erga omnes, so regarding everyone. That's the company statutes, the Articles of Association, which have which give the structure of that corporate environment. And the other one, the shareholders agreement, which is much more specialized. It's private law between the contract partners, and that's more specialized, which has only inter partes effect from a legalistic standpoint. Yeah. Any other questions from the audience? I see that Pinal is back. Do you have a question with regard to the earlier point that we had made?
No, just a comment to clarify. I received a proposal from a company in Paris or in France, and it was difficult for me to evaluate or place valuation. That's why I was asking about the valuation models that are, there is no perfect valuation model now because some of the historical trends, I don't know that we can rely on them given the past 2 years or the past year of what's happened. So that was my mindset for asking for that clarification. And I think that was it. Thank you very much. Yeah.
Thank you, Pinal. If there are no further questions, we can also switch and go to the informal part of this conversation we have today, and do networking and breakout rooms. So a last question, any further questions before we close down the substantive governance part and have private conversations? Okay,
maybe I would.
Yes.
Maybe I would like just to say something. Yes. I think it's a really, thank you very much for all of this, all of those insights to our speakers. And I think what is really interesting is that we see that there are many questions on those issues that are related to the management and the growth of the company. And if all of our attendees today have other questions that they would like us to tackle in other with our speakers that we have here today in other sessions that we can organize next year, please send them to us and give us the ideas of what you need, what you would be looking for, and what kind of topics we can cover, because as we see, it's basically around questions around the growth of the company, how you structure the governance. So if you have any needs or any questions, please, you can come to us. We are here for that. So that was just what I wanted to say, and it was very interesting also for me. Thank you.
So Andrea, Christina, can you organize the breakout rooms? So we're maybe 7 people per breakout room and take maybe 10 minutes for 2 rounds or so. Like
yes.
10 round. Let me just moderate off this with a closing statement. We're impressed by the number of high-level participants and the good quality of the discussion we've had today with this first webinar on governance organized by the European Champions Alliance. We thank you for having taken the time to participate and for the pertinent questions that were addressed to our exceptional panelists. We will shortly publish a short summary of today's webinar on the website, european-champions.org. Additionally, we offer you the possibility to pre-order your copy of the guide by answering our post-webinar survey. If you would like to stay posted on the latest developments in the European tech sector, you may want to follow us on LinkedIn, Twitter, and the European Champions Alliance YouTube channel and website. And we encourage you to be proactively involved in promoting and developing European tech, especially if you want to grow your scale up in Europe. We simply encourage you to become part of the ECA family, and all information on how to become a member is available on the website. And keep in mind, as Olivier Gras so beautifully puts it, to have your head in the stars, you have to have both feet on the ground. And with this, I think we can close the recording of this part and go to the informal gathering to get to know each other better and have more private discussions on governance. Thank you very much.